Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. With me today is David Blake, CMT, here to discuss what's been going on in the market recently and what we need to look for this week. Now, David, you have been out on some very exciting travel lately, so it's been a minute. And last week we had a really big Fed meeting. Can you get us up to speed?
Yeah, actually, last week was probably one of the more volatile weeks we've had in the market over the course of the year. We kind of had a seesaw little market. We had a lot of AI concerns popped up again, and we continued to get this rotation out of the AI related shares and also big cap technology into more cyclical sectors of the market, more economically sensitive areas. A lot of the financials and materials, industrials, that type of thing. And as you can see, like even yesterday when we had a down market, 8 of the 11 sectors were actually up. And what weighed on the market basically was just high tech and also energy. Energy just cannot get going here, although I think it's probably something to be looking at here as the economy picks up a little. But anyway, we started out last week. Investors were a little bit cautious over on Monday and Tuesday. The Dow was down almost 400 points on a 2-day slide before the FOMC meeting. And then on Wednesday, we got the quarter point rate cut that we were expecting. And that triggered kind of a rally. We saw the Dow actually trade up 1,100 points over the next 2 days. And we had the Dow Jones, the S&P 500, the NYSE, and the Russell 2000 all post new record highs. So it was a pretty broad-based rally. We got the quarter point rate cut. We also had kind of a small quantitative easing component where the Treasury is going to buy like 40 billion in T-bills a month just to kind of prop things up a little bit. So that was a little bit better than what the market was expecting. But again, what we saw with the big cap tech and the AI related stocks, they kind of weighed especially on the NASDAQ. We saw Oracle come in. They reported earnings. They were a little bit light on revenue and guidance, especially with all the debt that they're putting out to build these AI data centers. And then also Broadcom pushed out their guidance on revenues from the AI build out also. So you're kind of at a point now where people have been talking about an AI bubble. I don't know that it's an AI bubble, but it is something with all the money that's projected to be spent on AI. Investors, institutional and retail, they're ready to start to see, okay, when are we going to see revenues from all this build out? You just can't stretch it out and keep talking about it for a while. We want to start to see results here pretty soon. So after that, are rotating out until we can start to see a little bit more of a pickup in revenues from the AI build out. You saw the semiconductors pull back last week. In fact, on Friday alone, the sell-off in the Philadelphia Semiconductor Index, it was down 5% just on the day. Now, one of the other problems with this is that if you watch the yields in the bond market, they're stubbornly staying high. You're basically on the 10-year about where you were in September before you've had these 3 rate cuts. And we're sitting here right around 418, 419. Today we had jobs numbers come out for October, November. And despite the fact that you're seeing a softening jobs market with the unemployment rate, it ticked up in November to 4.6. Rates aren't coming down. And one of the problems here is that people still are afraid that we're going to see more inflation the first of the year. And normally, I have to tell you that 35, 40 years in this business, that the bond market is usually correct, which as long as they stubbornly stay high, it's going to put a little bit of a cap on upside of market going forward. I'm not like this is it, you need to get out, but I think it's just going to struggle. And on that same wavelength, as we saw the market push to new highs this year, a lot of that was due to the Mag 7 and also the big cap technology again. Now, if we rotate out of that, despite the fact that we're seeing 8 of 11 sectors nudging higher, the overweightedness of those stocks is going to probably weigh a little bit more on the NASDAQ. So you're going to see the NASDAQ probably most likely underperform. In fact, there's an ETF that you can look at as an equal weighted ETF for the S&P 500 rather than the normal one. It's RSP, and that is the S&P 500. However, it's an equal weighted index. So if we are seeing a big rotation out of some of the NVIDIAs and the Microsoft and that type of thing, you're going to probably have a better return than you would with the regular S&P 500, the SPY. So that's something to take a look at. Okay, the technical condition of the market is still positive. It was a little bit mixed last week. We did make new highs, but the new highs were kind of flat uh, on a flat AD line. I think the NYSE AD line only picked up about 400 or 500 units, which is not what you want to see. Normally, when you're making new highs, you'd like to see the AD line pick up a couple thousand units, but we didn't see that last week. We did see some expansion in the 52-week new highs versus new lows. In fact, on Thursday of last week, the NASDAQ had 370 new highs. That was the most in, for a while. We also had some things that we looked at on the Dow Jones. It had a bullish triple top point and figure chart breakout last week. The S&P 500 and the Russell 2000 had bullish double top point and figure charts. And you can find those over here. If you take a look, let's go to DIA. That's the diamond. That's the Dow Jones ETF. Take a look over here at the point and figure chart. You can see over here, we have it for you. 1, 2, 3. Okay. It bursts out of a triple top buy signal for that. That's usually a pretty bullish sign for the market. Usually you're going to get a little bit of a kick on that. If you count these 1, 2, 3, 4, 5 boxes across and you go up here to the breakout, 1, 2, 3, 4, 5, you're probably looking at a pretty nice little move going into the end of the year on the Dow. Take a look here at the IWM. That's the Russell 2000. And again, you can see another point and figure breakout on that, which is a bullish buy signal for point and figure chartists. And there are a lot of people that just follow that. I also have been talking a little bit about this rotation out of the tech and into some of the more cyclical areas. I wanted to take a look at a couple of things on here. Okay, number one, we had two sectors actually hit all-time highs last week. That was the XLF, which is a financial sector. And what you can see here, I wanted to show this especially. You can draw a trend line on here and you see how the action here is. You can see how it's been topping out right over here. And then all of a sudden here, a couple of days ago, last week, we saw a breakout of this off the tops. Okay. I'm sure if we did a point and figure chart on this, you see a breakout of that, which we can look at later. But if you're seeing this, we have a breakout to the upside on the financial. That's because you're seeing a steepening in the yield curve, which is bullish for the banking stocks. If you look at the new highs and new lows, you're going to see JP Morgan, Citigroup, Goldman Sachs, these stocks making all-time highs with this steepening yield curve. So that's something you want to take a look at. And that's actually just tells you that now we're on an up leg. Here's another one with the industrials. And again, on this one, we go back here and again, we draw the resistance line. You can see where it struggled every time we got around this area. And then last Wednesday, just like the financials, we broke above that. Now, you see this pulled back a little bit here for the last 2 days. I'm not sure what it's doing today. But a lot of times when you have a breakout like this, and the more times it tests this trend line or resistance line, the stronger the breakout is going to be. Here you get 1, 2, 3, over here 4, and we broke out here on the 4th time. When you get these, 4 and 5, 6 times where it goes up and hits that resistance and backs off, when it finally does break out, that's an even stronger buy signal. Another thing we have here is the XLY, the consumer discretionary, which is something that's good. That's economically sensitive. And this actually goes back even further. So if we come back here to this area, again, you draw the line across here, and we're in the process on that sector also of breaking out to a new high. I want to show you one thing I just mentioned that you actually could almost say you have a bit of a reverse head and shoulders, which is another bullish chart pattern on some of these. Not real good on this, but some of the other ones are strong. But a lot of times when you actually break out of this new high, and again, you have 1, 2, 3, this was the 4th test on this, and we're finally breaking out. You'll come back, you'll break out, and you'll come back and retest this as support and then head back up. A good example of this, I've been talking about that we want to be buyers in the healthcare sector. And if you look over here, okay, come along. This goes all the way back to the first of the year. We draw the line across here. Some people might say this is a cup and handle, which is another bullish pattern. But as you see here, okay, we break out, boom, we have a nice run up, came back, and where did it come back to? Right where it broke out at. That resistance now becomes support. It's called a polarity effect in charting. So we came right back to where the breakout occurred, and now we're bouncing higher again. That's a classic sign that you want to see on the chart that shows you this is an area that you want to be. So these are some examples that we're seeing this rotation. It's kind of confirming that the rotation is taking place. Again, the reason that you don't see the market breaking out like this is because of the overweighted tech stocks. Now, here's the technology sector. Okay, we break out over here. Let's just say we're getting a little bit of a breakout. Let me grab this here. So we see a little bit of a breakout over here. Not a real crazy breakout because you've been in an uptrend for so long. Actually, the breakout was over here back in the summer when all of a sudden we had this big rally again. But as you can see here, that it's even at this level, you had that little breakout over there, and now you're starting to break down below that resistance line was support, and now you're breaking below that support line. So this is probably telling you that you're going to have a little bit more of a pullback in that area, and you're seeing some slowing down in momentum on that case also. So that's something that is confirming the fact that we're seeing that rotation out of there. So that's kind of something I want to see. One other thing, and this is another confirmation one, I think we're going to start seeing more new highs. There's something called the Dow theory. You can read about that just about anywhere. And the Dow theory basically says that when the Dow Jones is making a new high and the transportation index is also making a new high, that's a Dow theory buy signal. It was very important back in the 30s and 40s, even in the 50s. I'm not so sure it's as strong a buy signal as it was back then, because back then it was, if you're making product, you have trucking and railroads and airport, you're moving product like that. Today we move so much product on the internet and that kind of stuff. But in any case, you go back here and we go all the way back into the beginning of the year, and we come across here and look at that. That's okay. We have 1, 2, 3, 4, 5, 6. Now the seventh time the transportation's ETF or indexes has tested that resistance line, we finally broke out. Yesterday, in fact, even though this shows that the index was down a little bit, the airline stocks were a pocket of strength yesterday. In fact, we had Delta and American Airlines making new 52-week highs. So that looks good. The cruise lines are starting to look good in here. And of course, they're more consumer discretionary. But anyway, when you draw these long-term resistance lines like this on your smart chart, it's an area that when you see this, you want to pay attention, because this is a complete trend change here. You have a breakout that you don't get to see this often, this strong a thing like this. So because of all these breakouts, I do think we could see a little bit of choppy action here, because we've had a pretty nice run in some of these. But I do think that once going into the new year, we're going to have a pretty strong market. You saw the CTI, looks like we bottomed in over here with all the different indexes back here in mid-November. That's what I look at as probably the bottom of the cycles through here. And we're off. We had 3 cycles reset, the A, B, and the C. That's the 6-week, 18-week, and the 36-week cycles. And I should give an upward bias to the market over here for a little while. As far as I'm concerned, I think you can use any pullback. I think you're going to see people buy the dips, investors buy the dips as we move forward in the end of the year. And at this stage, I don't see anything that's really going to shake things up unless we, again, in this market, it always comes down to yields at this point. And if inflation ticks higher than what they're looking for, that's probably going to limit rate cuts, and that could put a little bit of a damper on the market. But inflation also is good for growth, but for earnings and stuff like that. So that's a dual-edged sword. Other than that, I think that's about it. Go into your charts, look at some of these sectors, and you can do what we did here today, and you'll see the different sectors that are breaking out. Again, like the materials, the financials, the industrials, consumer discretionary, the transports look good in here. And then you go in here to your industries or your screeners or your watch lists, and you can find out what stocks are, outperforming. Now, here's something that I do. I run an ETF portfolio for myself. And if you look at what's going on over here, let's go to all sector ETFs. I have stuff in here. And we want to look at, say, the power rating. What do you have? Okay, you have biotech, pharmaceuticals, silver, which is good. You're starting to see the oil service holders starting to outperform. I told you that I think the energy sector is bottoming here. And here you have the transportation. It's one of the strongest ETFs. Come down here, oil services again, and more biotech, more pharmaceuticals, biotech. biotech. That's just confirming that these are the strongest ETF sectors that you're seeing in the market right now. So when you go to here and you're thinking about buying something, because the weakest sections over here, and this is telling you I would stay away from software right now and social media and the internet and even Chinese internet over here. These are the weakest ETFs in the market right now. So that's something you can look at when you're starting to come up with ideas that you want to invest in. And you also want to, as I always say, you look at the 50-day relative strength. You want to make sure these are outperforming the S&P 500. You don't want to buy something that's underperforming the S&P by 10% or something like that. So I hope that helps you a little bit.
That was great. Thank you so much, David. Is there anything else we need to know as we head into the rest of this week?
Not really. We had the jobs data today, and then on Thursday, the BLS is going to release the Consumer Price Index, CPI, for November. Right now, they're looking at 3.1% year over year. The core CPI, I think, which excludes food and energy, they're expecting a rise of 3% year over year. So still a little bit hot. Now, if you would come in at 3.2 or something like that, would probably shake things up with the market. If you come in a little bit lighter, market participants will probably start talking about a January rate cut, which I'm not so sure about right at this stage. But anyway, that's something to look at. And other than that, we have Micron earnings, I think maybe tomorrow. It's going to be light on earnings this week, but there's a couple of heavy hitters coming in that we can that may move the market a little bit.
Very good. Well, if you liked what you saw today and you're interested in more technical analysis research, feel free to check us out at MarketEdge.com. Until next week, my name's Rachel. This has been another Tech Talk from MarketEdge.com. We'll catch you next week. Thanks so much.